Morning, team. We're going to talk a little bit today about conventional loans. Now, I know a lot of you are comparing, what's the difference between jumbo, conventional, non-conforming, conforming, FHA, VA, USDA, TSHAC, SEF. I mean, there's a lot of different programs available to you out there. So what's the best program for you? So today we're going to talk a little bit about conventional loans. Now, conventional loans are based primarily on fixed indexes, right? So you've got the 30-year, the 15, and the 20-year, which are the most popular, right? Once in a while, you find somebody that offers a 10-year, and technically there are conventional arms, 1, 3, 5, 7, and 10, right? So let's just talk a little bit about high level what a conventional loan means to you. So a conventional loan, let's just say it's a 30-year fixed, will be amortized, which means that the payments will be scheduled over 30 years so that at the end of a 30-year term, your loan will be paid off. The advantages of the conventional loan is that one, your mortgage insurance falls off if you have a 22% equity position or you put down 20%. Well, what does that mean exactly? How much do I need to put down on a conventional? Well, there are different conventionals that are out there, but most conventionals have a 3, a 5, a 10, and a 20% down. Right? So, of course, if you go with the 3% down, you're going to have absolutely stellar credit, right? And your mortgage insurance is going to be a little bit higher. On most programs, there are some variances, but we won't go down that rabbit hole, right? Second is the 5% down. The 5% down is what you're most typically going to hear from other lenders. You're going to hear a lot of the 5% down programs that are available out there. And how that works is if you put down the 5%, now this has to be from your own funds, right? Not a gift. You put down the 5%, and also, little side note, beware the closing costs and the prepaids, right? So if it's a $200,000 home, it's not just 10 grand out of pocket, right? You're going to have your closing costs, you're going to have your taxes, your insurance, things of that nature, right? So just be aware of that. If you're planning on buying a $200,000 house, don't automatically assume that it's only your down payment. So anyhow, I digress. So if you put down 5%, how it works is that that money has to come from your own funds. It's got to be sourced for at least 2 months in your bank account. And once you purchase the home, you'll have mortgage insurance unless you took a higher interest rate in lieu of that or you paid upfront, right? So let's just assume that you've got mortgage insurance because 90% of people do if they only put down 5%, right? You have the mortgage insurance typically until you hit a 22% equity position. Most people think it's 20%. It's really 22%. You want to be 78% loan to value unless you put down 20% up front. So if you're paying it down, 22%. If you're putting it down up front, 20%. Easy stuff, right? So conventional loans are typically, and this is something you want to ask, don't have any prepayment or pay down penalties. After the market crashed, a lot of lenders got away from prepayment and pay down penalties. That's not the case in today's market, right? There are a lot of lenders out there that are now reintroducing prepayment penalties. It'll give you a lower interest rate, but if you pay it off or refinance it within a set amount of time, it will cost you a lot of money to pay that penalty. So be extra cautious of that as well. So conventional loans are probably my go-to loan if a client has over a 680 credit score. Anything lower than that, you want to start looking at some government programs, right? If you've got a high 700s credit score, conventional all day long. If you're only going to live in the home or you know that you're only going to keep it for a very short amount of time, let's just say a couple of years, you might want to look at the ARM products. I know they got a bad name back in the day, but they can save you a lot of money. If it's a flip and you're only going to hold it for 6 months or less, you're going to want to talk to your lender about what's called premium pricing. Put a little note there. Basically what you're doing is you're taking a little bit higher rate, but it waives all of your closing costs, and sometimes it can even pay for your prepaids, your taxes, and insurance with the pricing, right? But most people anticipate being in a home for a long period of time if it's their primary residence. So just be aware that if you're putting down anything less than 20% up front, you're either going to have mortgage insurance or you're going to have to do a hybrid program where you pay the upfront mortgage insurance or you do a TAMI program or TaxSmart program. And those we'll talk about in a different video. So just to kind of sum it up in a nutshell, the easiest program that's out there is the conventional loan. It comes in a variance of ARMs and fixed rates. They're probably the most popular programs out there for people with above 700 credit score and have money to put down. If you have any questions or anything, feel free to give us a call anytime. Have a great one today.